When people first learn about investing, they hear one idea over and over again. Just invest for the long term, and compounding will make you rich. So they start. They open an account. They buy some stocks, they hold, and they feel like they're doing the right thing. But here's the hidden assumption behind that advice. It only works if what you own is capable of compounding, and that's where most people go wrong. Because not all stocks are designed to grow over time. Some businesses are built to expand, others are built to survive. Some create more value every year, others slowly lose it without making noise. And when you mix those together in your portfolio, compounding doesn't accelerate, it stalls. Let's simplify this. Compounding is not magic, it's just a process. A company makes profit, reinvests that profit, grows, makes more profit, repeats over and over again. Like planting a tree that grows, drops seeds, and grows more trees. But if the company can't grow profit, can't keep customers, can't survive long enough, then the cycle breaks. And when the cycle breaks, compounding stops. So let's walk through the types of stocks that quietly destroy this process. Type 1 businesses with no real advantage before Berkshire Hathaway became a multi-billion-dollar empire. It was just a struggling American textile company. That's what Warren Buffett originally bought. It looked cheap, factories, inventory, a long operating history. Buffett believed he could turn it around, so he kept buying shares until he took control. But there was a problem he couldn't fix. The entire industry was losing its edge. Textile production in the US was becoming more expensive. Higher wages, higher operating costs. At the same time, manufacturers in developing countries were producing the same products at a fraction of the cost. Same function, same output, much cheaper price. So what happened? American textile companies started losing their advantage. Not slowly, but structurally. No matter how efficient Berkshire became, it could not compete on cost, and in that industry, cost was everything. Buffett tried to improve operations. He managed it better than most, but it didn't matter because the advantage wasn't inside the company. It was outside in global economics. Lower cost producers kept taking market share. Prices kept falling, margins kept shrinking, year after year. The business generated less and less real value. Until Buffett made the decision, he shut it down, and only after exiting that business did Berkshire begin its real compounding journey. Here's the key idea. This wasn't just a bad company. It was a business with no sustainable advantage, competing against players who were structurally better positioned, and in that kind of environment. The outcome is predictable, revenue stagnates, margins compress, profits decline, and eventually the business either shrinks or disappears. The lesson is simple. If a company has no advantage and its competitors are structurally stronger, time doesn't help. Time exposes the weakness because in investing, businesses without an edge don't compound. They slowly fade. Type 2, businesses that can't raise prices. In the airline industry, one of the most painful lessons in investing came from companies like US Airways. At one point, even Warren Buffett invested in airline stocks. The logic seemed reasonable. Air travel demand was growing. More people flying every year. Globalization increasing. It looked like a perfect long-term trend, but the reality was very different. Airlines operate in one of the most competitive environments in the world. Multiple carriers, similar routes, nearly identical service for economy passengers. And most importantly, customers don't choose based on loyalty. They choose based on price. If one airline charges more, passengers simply book another. So what happens? Airlines are constantly forced to keep prices low. Even when their costs increase, fuel prices go up, labor costs rise, maintenance becomes more expensive, but ticket prices, they barely move, or worse. They go down during competition, so airlines get trapped. Rising costs, flat or falling prices, shrinking margins, even when planes are full, profits remain thin, sometimes non-existent, and during downturns, losses pile up quickly. That's why for decades airline companies struggled to create consistent long-term returns. They had demand, they had scale, but they didn't have pricing power. And without pricing power, there is no real control over profit. This is what Buffett eventually realized after years of avoiding airlines. He once joked, "The worst kind of business is one that grows rapidly, requires significant capital, and then earns little or no money." That perfectly describes businesses that can't raise prices. The lesson is simple. If a company cannot increase its prices over time, it cannot protect its margins. If it cannot protect its margins, it cannot grow profit. And if profit doesn't grow, compounding doesn't exist. Because in investing, it's not enough for a business to grow, it has to grow profitably. And that only happens when the business has the power to charge more tomorrow than it does today. Type 3 businesses, customers can leave instantly. In the early days of the internet, one of the most dominant companies in social media was MySpace. It was everywhere, millions of users, massive traffic, cultural relevance. At one point, it looked unstoppable. Then in 2005, media giant News Corporation acquired MySpace for around $580 million. The belief was simple: social media was growing fast. Attention was exploding. This platform would keep expanding. And for a while, it did, but underneath the growth, there was a hidden weakness. Users weren't locked in, there was no real switching cost, no deep ecosystem, no strong habit loop, no reason users had to stay. So when a better product appeared, everything changed. That product was Facebook, cleaner interface, better user experience, stronger network effects, and most importantly, people could switch easily. No contracts, no friction, no penalty. So they did, gradually at first. Then all at once, users left, traffic dropped, advertisers followed, revenue collapsed, and just a few years later, MySpace became irrelevant. Eventually, it was sold for a fraction of its original price. Here's what really happened: the business wasn't protected. It looked big, but it wasn't stable, because when customers can leave instantly, they will, and when they leave, everything leaves with them. Revenue, growth, future potential. The lesson is simple: if a business cannot retain its customers, it cannot build long-term value, because compounding requires accumulation. But in a business like this, you're not accumulating. You're constantly restarting, and in investing, a business that keeps restarting never compounds. Type 4: businesses in a dying industry. Now imagine this: you're the best DVD rental company in the world. Amazing service, great selection, loyal customers, but streaming arrives and suddenly everything changes. The demand starts shrinking, not overnight, but steadily, and no matter how well you run the business, you're fighting a losing battle, because the industry itself is declining. This is one of the hardest truths in investing. A great company in a bad industry is still a bad long-term investment, because compounding needs expansion. And if the market is shrinking, there's nothing to expand into. You're not climbing a hill, you're standing on one that's slowly collapsing. Type 5: businesses that might not exist in 10 years. In the early 2000s, one of the most dominant companies in mobile phones was BlackBerry. It wasn't just popular, it was essential. Business professionals relied on it, governments used it, email on your phone felt revolutionary. At its peak, BlackBerry controlled a huge share of the smartphone market. It looked like a long-term winner, a company built to last. But there was a hidden risk. Its advantage was tied to a specific moment in technology: physical keyboards, secure messaging, corporate email. Then in 2007, something changed. Apple introduced the iPhone: no keyboard, touchscreen interface, a completely different way to use a phone. At first, it didn't seem like a direct threat. BlackBerry was still dominant in business, still growing, still trusted, but the shift had already begun. Consumers started switching. Developers followed, ecosystems formed around new platforms. And suddenly, BlackBerry's strengths became weaknesses. It couldn't adapt fast enough, its operating system fell behind, its product felt outdated, and within just a few years, its market share collapsed, from dominance to near irrelevance. Here's what really happened: BlackBerry wasn't a bad company. It was a company exposed to disruption, and in industries driven by technology, that risk is always present. The lesson is simple: if a business might not exist in 10 to 20 years, it cannot compound for 10 to 20 years, because compounding needs time. But disruption removes time, it cuts the future short. And in investing, it doesn't matter how strong a company looks today, if tomorrow can erase it completely. Type 6: businesses that grow revenue but not profit. In the late 1990s, investors were obsessed with one idea: internet companies were the future, and one of the most famous examples was Pets.com. The company was everywhere: Super Bowl ads, massive marketing campaigns, rapid growth in customers. Revenue was increasing fast: more orders, more users, more attention. On the surface, it looked like a perfect growth story, and investors believed, if it's growing this fast now, imagine the future. But there was one problem: the business wasn't making money. In fact, it was losing money on almost every sale. Shipping heavy pet food across the country, selling at low prices, spending heavily on advertising. The more it grew, the more it lost. Growth didn't fix the problem, it amplified it. Eventually, reality caught up. The company ran out of cash, and in 2000, Pets.com shut down completely. Here's what really happened: the business was designed to grow revenue but not profit. And that's a critical difference. Because revenue is just activity, profit is what remains. Profit is what gets reinvested. Profit is what compounds. If a company cannot turn growth into real earnings, then that growth has no foundation. It's just expansion without accumulation. The lesson is simple: if a business grows revenue but not profit, it doesn't compound, it consumes, because compounding requires surplus. But in a business like this, there is no surplus, only more scale and bigger losses. Type 7 businesses with poor decision makers in the early 2000s, a once iconic company named Yahoo, had everything going for it. Massive traffic, a dominant position on the internet, multiple products, search, email, news, advertising. It was one of the biggest tech companies in the world. And at one point, it even had the chance to buy Google, twice, for a relatively small price, but the leadership hesitated. They didn't fully understand how powerful search would become. They passed on the deal years later. They made another critical decision. They acquired companies but failed to integrate them properly. They invested but without clear direction. They kept shifting strategy, no focus, no long-term vision. Meanwhile, competitors executed better. Google dominated search, other platforms captured attention, and Yahoo slowly lost relevance, not overnight, but decision by decision, opportunity by opportunity. Until eventually the company declined and was sold for a fraction of what it could have been worth. Here's what really happened. The business had potential. The market was growing, the timing was right, but the decisions were wrong. And in investing, decisions compound too. Good decisions build momentum, bad decisions destroy it. Slowly, silently, relentlessly, because compounding is not just about the business model, it's about how capital is allocated over time, where money is invested, what opportunities are taken, what risks are avoided. If leadership makes poor decisions, even a strong business can weaken. The lesson is simple. A great business with poor decision makers will not compound because in the long run, it's not the opportunity that determines the outcome, it's what you do with it. Now step back and look at all these types together. They seem different, different industries, different problems, different situations, but they all share one thing. They break the compounding loop either. The business can't grow profit, or it can't hold customers, or it can't survive long enough. And without those three things, compounding simply cannot exist. But here's the deeper insight. This is not just a financial problem, it's a psychological one because the types of stocks that destroy compounding are often the most attractive. They're exciting, they're cheap, they're trending, they give you a story. And humans love stories. We want to believe we found something special, something early, something big, but compounding doesn't care about excitement, it cares about consistency, it rewards patience, it rewards stability, and those things feel boring. So what should you actually do instead of chasing what looks promising? Start filtering what's dangerous before you invest in anything. Ask simple questions. Can this business raise prices over time? Can it keep its customers? Is the industry growing or shrinking? Will this company still exist in 10 to 20 years? Is it making real profit or just growing on paper? And do the people running it know what they're doing? You don't need perfect answers, but these questions protect you. Because in investing, avoiding big mistakes matters more than finding perfect opportunities. At the beginning, we imagined someone investing for 20 years and getting nowhere. Now you know why. They didn't fail because they lacked discipline. They failed because they trusted the wrong types of businesses. Because compounding is not automatic. It's conditional. It only works when the foundation is strong. And sometimes the most important investment decision you'll ever make is not what you choose to buy, but what you choose to never own.